Hey, everybody. Welcome to our Quantum Capital YouTube channel. We're so excited to put out compelling content, information for you to make decisions on investing and just kind of what's going on in the world of real estate and the economy at large. I'm joined by three of other partners on Quantum Capital: Nick Amaluxon, who is our Chief Operations Officer, Cliff Chung, who is Head of Investor Relations, and the founder and principal of Quantum Capital, Mark Henteman. Welcome, guys. We've laid out the case for multifamily. I think it's very clear. I say it all the time. People ask, like, how do you invest in a hot market? It's like, how do you invest in any market? Find good neighborhoods, good assets that you don't buy at retail and you force the appreciation and then catch the market, right? Like that's how you buy. But how do you vet the person buying? So Mark, you invest in a lot of passive deals. I invest in some passive deals. I'm sure we all have some exposure to different operators, but I'm just curious what's the number one or two standards that each of you have for vetting the syndicator or the operator you want to invest with. So anybody jump in, whoever feels passionate about this. I could see energy oozing from all three of you. All right, Cliff, you go. I'm looking at you. What are the top 2, 3, 1, 2, whatever criteria that you have when you're vetting a syndicator?
For me, I would say it's making sure that you understand principally why they're doing what they're doing. Not only in terms of investing in real estate, but their motives for wanting to work with other people. I think there's a lot of social media influencers out there who are putting together opportunities either in real estate or in any type of business. And because of the content that they've put out, that can be relatively misleading without understanding their motivations to put together such deals. So I would say just being very cognizant of the person's track record, what their motivations are, and just making sure that you trust this person or this group.
Go into motivations a little bit. What would be some things that would red flag you, or some things you're looking for as far as the person's reason for, opening a fund or acquiring property and using investor capital?
I would say it's always hard to discover what people's motivations are, but if you look at some of the deals that are being underwritten and some of the projections, I think trying to marry what people are saying in terms of market rents or expenses versus what actually is in place for market rents. If you can see that there's a really big disconnect, like if market rents are projected to be, say, $1,000, but right now in all the areas around this property, it's maybe $800 or $500. I think that's a really big, red flag, and that should make you question, like, why is this individual or this organization making such bold claims? And I would say, secondly, I see this in some markets that are very big boom markets, such as Phoenix. There's syndicators or investors that have been using since, say, 2018, 2019. They may not work for this next period of the market. So I think it's very important to understand people's motivations. And then number two, how they'll adjust given where things are going.
I like it. Nick, what about you? How do you vet your syndicators? How do you vet the operators you're investing with?
Aversion to risk is a big one. How do they feel about risk? Or it ties into what Cliff said. What they're doing before probably won't always work. But mainly just when you're looking at the deal, what kills it? What's the downside? And if the deal only works if everything goes 100% according to plan and you're top of the market rents and your bridge debt, that's too risky. I think that tells me that I'm not aligned with that operator. So alignment, I guess, but aversion to risk is what I look for. This is not that scientific, but general language, how are they referring when they're talking about the property and the business plan? What we do, at the end of the day is something that relates to housing, which, is very emotional and necessary, right, for people. So if it's all tenants and kick them out and yada yada, it's like, no, these are people. There's a residents with their homes, and we're adding value to the community. And if that's not the language or like the business plan, it's once again not aligned.
That's great advice. I like that. I say to people a lot who are newer. I talk to potential investors who maybe have never invested before, and I enjoy more educating them on the idea of investing versus, saying, well, this is, pitching, if you will. And one of the things I always say to people is look, get on operator calls for sure. They all look very similar in some ways, right? It's a PowerPoint. It's 2, 3 people talking about the opportunity. The terms might sound very similar, not too far off, all of that stuff. But it's in the nuances. And I love what you just said. Like, what's their language like? What is their approach? What's their sort of I don't want to say like moral code, but the way in which they're going about their business, right? But I always say too, ask questions, not like how do you conservatively underwrite, but maybe a question like, what are your debt terms, right? And then from that, to your point about conservative underwriting, I look for lower loan to value, and I look for maybe longer term debt, maybe interest only up front, or are they very aggressive with their loan to value, and they are very aggressive with their debt terms? Like you said, bridge debt, 3 years. I don't know, an 80, 75, 75, 77% loan to value right now with bridge debt scares me, unless there's tremendous upside, like ridiculous, out of this world. You found an incredible deal upside on a building. Those are kind of the questions I ask before I go to Mark. Nick, I just validate or give additional, like, what do you ask? What are some questions that you think a person should ask beyond? How do you make sure that if interest rates go up, that this investment won't go south? Like, that's a great question, but there's some questions within the question or some thoughts to look at, or maybe answers to those questions that I think are equally important or more important. What say you on that?
Yeah, I mean, if you're looking at a deal to invest in, I mean, I underwrite deals all day, every day, but just, I underwrite their pro forma. And if the returns don't match up to what they're projecting, that's a red flag. Although sometimes there are some nuances that, aren't in the pro forma you have to adjust for, but if it's a big variance, red flag. If you're looking at the rents that they're comparing, right, go and look, I mean, everything's online. Zumper, Zillow, apartments.com, just search up the complexes that they're saying are getting these rents. If they're not getting those rents, that's another, that's another red flag. And then if you have that, the underwriting model, and it is very aggressive on the financing or the exit cap rate or whatever, play with it, increase those, and however, until the deal doesn't make sense. And if it takes very little variables to make it a bad deal, that's too risky. Like you talked about, I've seen a lot of people use bridge debt just to get the leverage they need to hit returns, not because they need because it's, a relatively stabilized property. They're using bridge debt because if they used 65% LTV at the price they're paying, it wouldn't work.
Yeah.
They need to be heavily levered, and I don't know.
Yeah, it doesn't work. Real quick too. What about operators who don't offer a preferred return versus who do? What are your thoughts on the preferred return being offered? Because some don't.
A preferred return is certainly nice, but it also depends on how there are other fees in line. I see a lot of operators that don't do an acquisition fee for the 6 to 9 months it takes to close the deal. I mean, maybe not 9 months, but it takes time, right, to find and close and put everything together. So I have no problem with a fee structure that's aligned. But if you're doing no pref and an acquisition fee, I don't know if that really is. But also look at their track record. Is it long? Have they performed on it? Is the deal good?
Yeah.
Because that's you can have a 20% prep, but if the deal's trash, it doesn't really matter, right?
That's a good point. Yeah, great point. Mark, let's get the sage advice from you from being involved in this space for so much longer than we have at this point. But you've been investing a long time. You syndicated a lot of deals. So what are some of the things you look for that you would recommend people look for in vetting an operator?
Yeah, I think we're in a bit of a gold rush in terms of syndication. So there's a lot of people rushing into this space because they think they're going to make a lot of money. I think nowadays what investors are drawn to is the passive nature of syndications. However, unfortunately, I think to Cliff's point and to Nick's point, you can't really be totally passive. You've got to look at who this operator is, and you've got to do your due diligence. You've got to look at the deal and look at how they're underwriting it. Look at their assumptions. I mean, obviously, the assumptions that you could count on, last year in 2021 or 2020 are going to be different than what we experience moving forward. So you just got to make sure that your operator is being conservative, and you can. That's the quickest way to eliminate an operator is look at what their assumptions are. And if they're projecting the same rent growth as last year, I would walk away. I'd turn off your computer right then. Maybe I'm biased. Look for experience. I like people who invested on their own before they ever, chased the gold rush of syndication. Buy your own deal with your own money and do your own value add so that you understand it. You understand all aspects of the the process.
A simple litmus test for me. I say this all the time when thinking about where to invest and even, to partner eventually with Quantum was, okay, this is just because my brain gets overwhelmed quickly. There's so many operators, so many syndicators, and some of them are huge names, right? With billions or, whatever of dollars worth of assets under management. And that's all great. I'm sure they're all good. But for me, a very simple thing was, okay, there's 100 of you in the room with pitch decks, slide decks, with a deal that you're a deal or a fund that you want to put in front of me. How many of you raise your hand if you existed prior to 2008 and were syndicating? And like 3 of those 100 hands go up. And then at least for me, it narrows the field. It doesn't mean it has to be like, oh, if they didn't invest before 08, they're no good. Not at all. Not at all. But for me, at least, was if these folks are still standing after the greatest economic meltdown that we've seen in our generation, and hopefully we'll see, won't be for another long time before that happens again. There's something there. And then you can explore, to your point, Mark, what are the returns they're projecting? Are they being reasonable with rent growth and all that stuff? But I'm exaggerating a bit on 3, but it limits the field significantly. That's a big thing for me. Go ahead, Cliff.
I was going to also say, at least for some people that might not apparently have multifamily experience, also understanding that why they feel comfortable in entering the space, meaning, are they just looking to make a quick buck? Or do they really understand real estate? Something that's very helpful, especially in the personal development space, is understanding that you should be process oriented, not goal oriented. Because if you learn about cap rates, if you learn about maintenance and underwriting, and you really focus on the process of learning, and how things work, eventually you'll get to your goal. But if you just focus on, I want to make a lot of money, I want to acquire this many doors, and you don't really have the experience, I think that's a really huge red flag, especially with people that are raising funds and they're kind of like, oh, you're in real estate now? Wow, that's interesting. And if it seems like they don't really have a compelling story or reason for why they're in this space, I would say that's potentially a red flag.
Other than that they didn't like their job.
Yeah.
A compelling reason beyond that, like.
Makes sense. We'll leave it there, guys. I appreciate all the time and energy you put into this, and I hope everybody gets value out of it. For you out there, we'd love to hear from you. What do you think? Drop in the comments. Let us know your position on any of this. Are we right? Are we wrong? We'd love to start a discussion there. Be sure to like and subscribe so we can continue to put out content that's meaningful for you. And we'll see you all in the next one.